Labour data poses questions for the Fed. Welcome to Market Insight, I'm David Pollard. US private payrolls increased at a moderate pace in November, the ADP National Employment Report showed today. This, of course, following on from Tuesday's JOLTS report and coming ahead of Friday's non-farm payrolls report. Well, Eric Sterner, CIO of Apollon Wealth, joins us now. Eric, today's numbers were slightly below forecasts. Are we seeing a picture emerging this week of a slightly cooling or a slightly warming labour market overall, would you say?
Yeah, well, David, thanks for having me. This is the big week with the health of the labor market, again, under the microscope. I mean, we saw the JOLTS with a slight surprise to the upside yesterday, and ADP private payrolls a little bit down versus expectations. I do think the labor market remains very healthy, and we're still on target for a soft landing. I mean, it is cooling, and it's interesting to see yesterday in that JOLTS report how the quits rate actually increased for the first time in 1.5 years. So employees must be feeling pretty good about the status of the labor markets. The one thing that caught my eye and probably caught the Fed's eye as they're evaluating the labor market is last week in continued claims, the weekly continued claims, it eclipsed 1.9 million for the first time in 3 years. So it shows that companies are in a low hire, low fire mindset right now. And we know there's still some noise in the labor market reports due to the effects and the cleanup effects of the hurricanes. But I think overall, it remains very healthy. And some companies may have been holding back hiring until the election results were in front of us, which obviously are now. So we'll see if that hiring picks up. But overall, I think it's a great picture for the U.S. economy and the labor markets in general.
You mentioned the Fed there. Markets appear to be upping their bets on a December rate cut, but policymakers have been quite reticent on the outlook in recent days. Powell is also due to speak, and he has consistently maintained a cautious tone thus far on the prospects for rate cuts. What do you see coming ahead?
Yeah, we've seen some mixed talks from Fed officials over the past few weeks. I mean, we just saw Waller this week with his comments. It seemed a bit more dovish, that he seemed to be a bit more in favor of a rate cut in 2 weeks, while Powell seemed a bit more cautious and just knowing the strength of the U.S. economy, feels that he doesn't need to rush the rate cuts. I do think that, I mean, we'll see who the results are from Friday's labor market report, but I do think we are in line for another 25 basis point cut. Certainly, there are some concerns about what Trump has said in his economic plans that could reignite inflation. But the Fed's going to make decisions based upon the data in front of them. They're not going to project or predict what Trump is going to do. So I think another 25 basis point cut is probably in the cards in 2 weeks. And what I'm really interested in is the dot plot and where they project rates to be going forward. We know at their last dot plot in September, they were projecting 100 basis points of rate cuts in 2025. I expect that to go down because inflation has been sticky. And the labor market report, the labor markets are holding up better than they expected. They're expecting the unemployment rate to be at 4.4% by the end of the year. We're still holding strong at 4.1. So I think that's where we'll see the changes in the dot plot for 2025.
Now, we've had a raft of very negative headlines concerning US-China relations this week on the chip-making sector, critical minerals, and today a $5 billion China-related charge for General Motors. How much is the sense of risk growing around China, especially with the prospect of tariffs further down the road under Donald Trump?
Yeah, it remains to be seen, how much of this is just pure negotiations. Because Trump has made some bold statements with tariffs, as we all know, and China's been a big part of that. Where during his campaign trail, he was talking about 60% tariffs on Chinese products. Even more recently, when there was talks about the emerging market countries led by China and Russia potentially creating a new currency, that's when Trump even upped it to 100% of all those emerging market countries. So I think China is just playing the game. We know we're probably entering another potential trade war, and it shouldn't come to a surprise that as Trump makes these statements, that China's going to fire back, and it's going to be a negotiation, and hopefully, calmer heads prevail and don't affect or have negative effects on both economies.
So how should investors play the outlook in a very difficult environment? I know that you advise investors to remain diversified, but with a tilt towards certain areas of the market. What are those areas?
Well, yeah, I think investors should remain optimistic. There's a lot to like between corporate earnings, the consumer spending, the labor markets, and Trump considers the stock market performance as a big part of his scorecard. And if he puts these tariffs out that he says he was, I think it's more of a negotiation, and is going to reignite inflation and potentially put an end to this bull market. So I think investors should just try to block out this noise, because I think we don't know yet what some of these statements, which statements will result in policy change. As far as areas in the market I like right now, obviously over the past 2 years, the mega techs have really led the way. I think we're starting to see, well, I should say, we're definitely starting to see more broadening out in the market between other sectors. And I really like small caps. I've liked small caps for a while. Now that they're very interest rate sensitive, we know the Fed is cutting rates. That should provide some relief to small caps. Their earnings growth are expected to exceed large caps in the second half of 2025. And they're more insulated from these trade wars. 90% of revenues for small caps are within the US, while large caps it's 60%. So if we do get into a trade war, it's going to affect large caps more negatively than the small caps. As far as sectors, I continue to really be a strong advocate for healthcare. I think these weight loss drugs are a huge innovation. They're expected to potentially bring in 80 to 140 billion in annual revenue by 2030. And certainly within all developed markets, we have aging demographics, so that there's going to be a need for healthcare. And then finally, the other sectors I will highlight are materials and industrials. Those are expected to have the third and fifth highest growth rates from an earnings perspective in 2025. We know manufacturing has been in a rut. The ISM manufacturing index has been in contraction territory for the past 2 years, but we saw an upside surprise this month. And I think as rates come down and there's more legislation to bring manufacturing back on shore, I think we should see a recovery within those two sectors.
Okay, Eric Stern is CIO of Apollon Wealth. Many thanks for being with us today and sharing your thoughts. And that is Market Insight. We have more videos on Reuters.com.